So guys, we'll start in 1 minute. I can see some more people trying to get in. All right, everyone, let's get started. So thanks for making it. I know the markets are quite exciting to be in right now, so thanks for being here. A quick reminder to people who are joining for the first time. We are a community of people helping each other out. You will see that all the presenters have kindly agreed to share their time. They're not doing necessarily for money or anything. It's sharing of ideas. So if you do decide to present, just reach out to me and we will get you in for the next time. Also, we do not recommend, we do not touch your money. You decide what you want to do with it. So just keep that in mind. For all the newcomers, we are a value investing club. We are trying to expand, to the extent we can geographically. And now webinars help, so you don't have to be physically in a place. So that's great. And we're seeing a lot of, so this session, by the way, is going to be recorded. It will be shared out with people. So there'll be more people who couldn't join today. So it's not just the people on the call here. If you wanted to look at any presentations from before, also I'll ask the presenters today if we can share it. It's all available on cityfalcon.com/meetup, where you can download the data. Also, if you're looking at all the things we've discussed, you can, we have a Google Sheet where we keep all the records and you can see how it's done. Interestingly, we've seen a bit of a decline in the last 1 month in the markets. So some of the returns here have been affected, and then we'll talk about it. But what you could do is you could go through the sheet, you can identify some things you want to look at, and then go to our webpage where you can download old presentations. So let's jump in. I'm not going to take too much time with the introduction because I want the speakers to spend most of the time. So we saw, this is Tesla's chart, and this is over a 1-year period, and we saw a bit of decline from its high where it reached, $880 per share, and now it's down. It's been quite volatile. It's Tesla, but it's down to the level where you see this big dip. So any ideas what caused this decline? And guys, I like to keep it interactive, so it's not just me speaking. So please, what do you think happened here?
Hi, Robert. Maybe can you hear me?
Yeah, go on.
Maybe just a bit of correction, really, but to be fair, nowhere near the level of correction that we need to be experiencing within Tesla, at least for me to even consider getting it. I think it's still skyrocket and very, really high, overpriced in my opinion. But yeah, it's welcome to see a good companies kind of dropping on value, becoming more accessible, but still very, very far away from the ideal price for me to get in.
Sure. Anyone else? Okay. So we'll see. So one of the things that has happened and made the market a bit nervous is about, the yields going up on treasuries. And this could be, primarily because the inflation expectation has gone up. We're seeing that, okay, now we have the vaccine, we're going to come out through this. So does the excess liquidity get dried off? Because what we've seen right now is that because of the stimulus, the printing of money goes into one asset class, that asset class rises, people have more money, so they're going to invest in another asset class. And this kind of creates, excess, and whether you want to call it, bubble or valuation or whatever. But this was one of the reasons why markets have corrected a bit, which is people don't expect necessarily the same extremely low interest rates. There is some expectation that things could move. And any thoughts from anyone on this?
I
Okay,
guess
we are a
people.
bit. Go on, Robert.
I guess people are scared of Biden's spending plans, and the rate has gone up so much that it's a question of where is it going to start affecting the market more? Is it already at the level where it can start affecting the market, or do we have to get to 2% before
Yes.
the market generally starts to correct? Because
Yes.
we've got so used to low rates, excessively low rates, that we kind of get worried when there's a prospect we're not going to keep them.
Yes, exactly. Any other thoughts?
I think maybe it also has something to do with the fact that the Fed is not really buying that much, and the Treasury is issuing more and more bonds. But I think this year so far they already issued 2.8 trillion, and the Fed is not really buying that much. So
Yes.
maybe that's also one.
Yes, I mean, of course, the demand supply of things, as you kind of rightly point out. Yeah, absolutely. Okay. But something to watch closely, and I think the market is watching closely as well. I picked out some charts. I try to look at different inflation data. So this is compiled by tradeeconomics.com, and it says it comes from US Bureau of Labor Statistics, and it has shown some kind of rise in CPI inflation. And I think in reality, depending on where you live, personally for me, I've seen food inflation going up. I mean, prices are going up everywhere. A lot of it, the inflation is also not necessarily showing the high numbers because energy is still at a low level. And once the oil prices start moving up, as the demand increases, we might see, inflation coming up. Any thoughts from anyone on this? Yeah, someone raised their hands. Sorry.
Yeah, no, that was me, Robert. Hi.
Okay, sorry.
I think probably an interesting question here will be what probably to hear from people in the call is what is people doing to protect themselves against inflation, and I think something that is obviously coming. We have borrowed record high amounts of money, and we need to create a bit of inflation really just to go with those amount of debt. So I guess from an investor point of view, what are people doing to protect themselves against this? What type of assets, commodities, stocks? So what are you guys doing?
Yeah, the floor is open for anyone. What is everyone doing anyone doing any option? Yeah, sorry, Robert, go on. If anyone wants to speak, you can unmute yourself and speak. So, okay, I think we lost. Yeah. Anyone doing anything in options, derivatives? Anyone buying put options? Doing anything? Okay, we are all waiting and watching for now. Okay. Another thing that happened, I mean, Bitcoin, as you see, has been moving quite a bit, and I've done an extract from our platform at cityfalcon.com. So sorry, it's a bit of a marketing plug as well, but when you look at the chart, what you can do is you can hover over. So we saw recently, very recently this week, I mean, yesterday, we saw a bit of a decline, and the story was that, the Fed shares had, Bitcoin is more like gold than dollar. But I think if you look at, again, with the media, it kind of gives a one-sided or a isolated story. But if you look at the full extract of what he said, which was quite interesting, obviously the things like, okay, it's speculative and all of that, Bitcoin, which is fine. I think all of us know that. Just 1 second, I just want to check. Yeah, sorry, some people were trying to get in and they had a problem. Okay, and then stable coins, is interesting. He points out about that. And I think there might be a thing where the Fed might themselves, and I think most central governments are looking into launching their own crypto digital coins, but more like stable coin structure rather than the volatility that we see with others. And then the last point, he mentions about how if there is a global currency which is managed by a private company, then it will receive the highest level of regulatory expectations. So quite interesting. And any thoughts from anyone on this?
I think we've already seen with Facebook, their currency was stomped on by regulators because they didn't want to see it happen. They're just confirming that, I think.
Yeah, and I think SEC is also going after Ripple. I don't know the latest this week on what is going on there, but it's something to keep in mind for anyone who's playing in cryptos. Just quickly before I hand over, if you guys want to use cityfalcon.com, you can create your watch list for 300,000 topics, stocks, commodities, anything, and then you can get news, you can get sentiment on what it's doing. We have a recently launched or launching new feature called a summary. So instead of reading thousands of stories, it summarizes the content. And then also we're launching investor relations soon, which is all the documents you find on Apple investor relations site or Facebook, it's all accumulated in one platform. And it's completely free to try. So, and if you have any feedback, let us know. So this is an example of how investor relations would look like. So we would have all the 10Ks, 10Qs, earnings presentations all in one place, and for major securities from around the world. Also, thanks to eToro, because they have opened up access for us to the value investors, sorry, on eToro, and I'm hoping that more of them will present. So Ishfaq is one of the value investors from there. And so thank you. And guys, if you feel like, if you want to check out the platform, you can try eToro.cityfalcon.com, which gives us a little bit of affiliate revenue to be completely upfront, but helps us maintaining the value investing club and also building at what we do at City Falcon. So that's it from me, and I'm going to hand it over to Ishfaq. Just some house rules, guys. If you have any questions, just drop them in the chat. Make sure you assign them to everyone and not just the panelists. So everyone can see your questions. Ishfaq and Manuel, I'll time you guys. So you have about 15 minutes to present, and I'll give you a warning sign, and then we'll cut off, and then the Q&As. So Ishfaq, over to you if you want to start sharing your screen.
Yeah, give me a moment.
Yeah. We can see your screen, yeah.
Good. Okay, hello Uzbek and hello to everyone. Today we're going to look at Essent Group, which is one of the private mortgage insurance businesses in the United States. Actually, if we look at 2022 market share, it's the second largest EMI private mortgage insurance in the US. The company has a market cap of about $4.8 billion US and $198 billion US in net insurance insured, with a $4.5 billion investment portfolio. The combined ratio for 2020 was 53%.
for it, like any insurance company, I think it is important to look at combined ratio, but here it's important to emphasize that 2020 was an exceptional year. If we look at the past 3 years from 2017 to 2019, the average combined ratio was 28%, which is the lowest in the industry. So what exactly is this industry? Let's talk first about mortgage insurance. If let's say you want to buy a house in the United States, you need at least 20% in cash for the value of the house. So if it's $1 million, you need at least 200,000 in cash. But if you don't have it, let's say you only have 150,000, you can still get a mortgage for 850, that is 85%, but that 5% needs to be insured. And there are 3 ways you can have this insurance: through the VA, the Veteran Affairs, the FHA, Federal Housing Administration, or one of the private mortgage insurance businesses. So the VA and FHA, these are government agencies, and the 6 PMIs, of course, they are private businesses. This industry has been recovering since the 2008 financial crisis. Of course, because of the housing crisis, it totally crashed, but now we can see the recovery is happening. And also important to note that after the crisis, the government agencies had most of the market share, but now the PMIs, the private mortgage insurance businesses, are now taking the market share away from the government agencies. So why is it better to go for a private company instead of the government? It's because, for example, the VA, they are mostly focused on veterans, so it's not available for everybody. And also the PMIs offer better rates compared to the government agencies. So in this industry, PMI, there's only 6 companies, and Essent Group, by most of the metrics, we can say they are the best. For example, you look at the loss ratio, it's again from 2017 to 2019, they have 4.0% on average loss ratio. There is National MI, which is doing a little better than Essent Group, but this is a young company. And I believe if they keep growing, they will now, they are being very choosy on their loans. But if they want to grow, they will have to expand, and they can't be so choosy anymore. So in the future, over the long term, I believe Essent Group can still maintain the lowest loss ratio. But if we look at combined ratio, of course, they have the best, the delinquency rate, one of the best returns on assets, return on equity. They have the best balance sheet. And if we look at the graph, they are one of the fastest growing revenues, earnings per share, free cash flow by 30% per year over the last 5 years. And of course, because of all of this, there is a premium on the stock. So compared to competitors, the price to book value ratio is 1.3. So Genworth Financial is an exception because they also have life insurance. But Essent Group is 100% focused on PMI. As I mentioned, the market share of the whole industry is growing, but Essent Group is growing faster than competitors. In 2015, they had 12% of market share, annual market share. In 2020, it's already at 18%, and they can be number 1, I believe, very soon. So what are the catalysts and risks for this company? Let's talk about the catalysts for the industry in general. We have record low mortgage rates, so people want to buy homes. We have this new trend, work from home, deurbanization. People are living in big cities because of the high rents, and they know that they can work at home in the suburbs or in rural areas. So they want to buy a new home. There's also asset price inflation with the Fed printing so much money, and real estate is considered an asset and investment asset, so prices are going up. Of course, all of this is causing higher demand for housing. And as I mentioned, the PMIs are taking market share away from the VA and FHA. And as far as Essent Group is concerned, they have the best metrics in the industry. They have good loans on their balance sheet. What do I mean by this is, if we go back to Genworth Financial, for example, this company has been existent before the 2008 financial crisis. So they still have some of the bad loans pre-crisis. But Essent Group, they were formed after 2008. So most of their loans are high quality loans. The management is now considering buybacks and increasing dividends. Only last year, they started paying dividends. So the risk, of course, we are we are in a housing boom. It's just started. I don't think we have a housing bubble yet, but there is a possibility that, let's say, 5-7 years from now, we may find ourselves in a new housing bubble. Of course, changes in interest rates and mortgage rates will affect the business. If mortgage rates go up, the insurance business will fall. But because Essent Group, like any insurance, they buy bonds, they constantly buy bonds, so their interest income will increase. So in some way, it will negate the effects of the rising mortgage rate. Of course, regulations will affect the company if the status of the GSPs changes. GSPs is the government-sponsored enterprises. Financial analysis 2020, again, I will emphasize on this, was exceptional year. So you will see that from 2019 to 2020, new insurance return increased very rapidly. 2021, it won't be that much, but over the long term, still, we can see that it's growing. New insurance return by 33% per year for the last 5 years. Insurance informed by 24% per year. Net premium earned 20%, net income 17%. And again, here we can see that the combined ratio 2020 was 53%, but before that it was around 30%. Returns on equity was around 20%, but last year 12%. So even in a bad year as 2020, they had a positive net income. The investment portfolio grew by 30% annually over the last 5 years. The debt, this is the debt for the company, not the debt about the loans. It remained more or less the same, and the book value increased by 30% annually. So the investment portfolio, most of it, about 99% of it is investment graded. They have US Treasury, corporate bonds, mortgage-backed securities, and 56% is AAA rated with 2.1% yield in 2020. Now let's talk about the valuations. I'm going to be very conservative with this company. It's like any other stock that I analyze, I like to be conservative. So even though in the last 5 years, revenues and free cash flow grew by 15% annually, by 20%, sorry, here I'm assuming that it will grow by only 15% annually. And I'm using a terminal growth rate of 3%, a little above GDP, with the discount rate, again, being very conservative, adjusting for risk of housing bubble and also that interest rate changes of 15%. And we can see that the intrinsic value of the company based on the discounted free cash flow is $9.6 billion US. And the market cap today is $4.8 billion US. So even with a big margin of safety, 20-25%, this company is undervalued in my opinion. If we look at the exit multiples based on price to book value ratio, over the last 5 years, the price to book value ranged from 1.4 to 2.5, and we are not counting 2020. And the average book value grew by 26% annually. So again, here I'm going to be very conservative. Even in the bull case, I look at a 20% annual growth in book value. In the base case, 15%, while in the bear case, 10%. I ignore the fact that they are going to buy back shares, so I'm taking the same number of shares outstanding as today in 2025 is going to be the same. So I calculated, of course, the book value per share. And from this, using the different multiples, we can see that even in the worst case scenario, if they have a price to book value ratio of 1.2, we can expect 53% returns in 5 years, which is 9% per year. We count the dividends, which is about 1.5% the yield today. Let's assume it's not going to change. So 10% returns per year, which is pretty good in my opinion for the worst case scenario. And of course, in the best case, we can go up to 38%. So looking at the different scenarios, different probabilities, and in my opinion, the expected returns is 26% per year for Essent Group in the next 5 years. So to conclude, once again, I will say that the intrinsic value, like we calculated, is 9.6, like we calculated, is $9.6 billion US versus a market cap of 4.8 billion. It is undervalued, even with a big margin of safety. We ignored the possible increase in dividends and possible buybacks. Even our exit multiples was very conservative. We saw that we expected book value to grow by only 15% per year, while it has been growing by more than 25% in the last quarter. And looking at that, we expect a 26% gain per year on the stock. Even in the worst case scenario, it's going to be around 9% annual return in 5 years. So just like any investment, I will say this, that it is always volatile. The stock price fell a little. 2020 it fell, but if you need to always focus on the long term. In the short term, nobody knows what will happen, but over the long term, I'm confident on this stock and I have it in my portfolio. I'm investing in it. So if you have any questions, I'll be happy to answer.
Sorry, that was that was quick. Thank you. I didn't have to time. Yeah, Ishwa, can you show us the price chart again, please, on the previous slide? Okay, so it's seen the March 2020 dip, and then it's recovered quite a bit. Yeah. And Ishwak, what is your view? So, I mean, you talked about, obviously interest rates going up is one factor, and you've been conservative. Also, the liquidity drying out from the markets, wherein people don't have money to put in. Also, maybe there might be foreclosures, so banks might increase. I don't know, the minimum required for mortgage might go up from, I think you said 10%. How do you consider those factors?
Yes, but right now it's actually 20%. With the record low mortgage rate, I think people want to buy homes right now. And even people who, if let's say, people who see this as an investment because of inflation, of asset price inflation. So even if, let's say, we have this scenario where you say that banks will increase the amount of money required to buy a house, I think, of course, it will affect the business, but I already took a margin of safety. I don't think the banks are going to change that. I don't think, but it is, of course, possible. We'll look at this, but I don't think it will affect the business that much in the margin of safety that we do. Of course, then everything will change. It won't be a 26% expected returns, but maybe it can fall to 20%. But still, with the margin of safety we took, I'm sure it's taken care of.
Thank you. And any questions from anyone else? Robert, do you want to say something? Yeah, go on. Yvette, go on. Guys, feel free to unmute yourself and speak. I'm struggling to unmute you. Yvette,
Right.
yeah, go on.
Here we are.
Yeah,
Here we are. Okay, so AM Best, I've written this down. It says that the business profile is assessed as limited because it's a monoliner, so one business. Maybe they might diversify, I don't know. And there's strong competition from other private mortgage insurers and governmental agency, the Veteran Housing Administration and Veterans Affairs. In addition, the product risk is considered as high because of the link to the macroeconomic environment, as we saw with COVID, although in the case of COVID, there were some compensations from the government. And also the standards set by the Fannie Mae and Freddie Mac. So is there any, I realize that the company is doing extremely well compared with peers, but it would still be reassuring to have your answers on these weak points.
So can you repeat your first point, please?
Ishwak, I think the questions are in the chat. I don't know if you can open the chat.
So one product only, right? Competition
yes,
from other providers, linked to the macroeconomic environment, and the high standards set by Fannie Mae and Freddie Mac. These were the weak points highlighted by AM Best, the credit rating company for insurance.
So I think that the fact that they focus on only private mortgage insurance, in my opinion, this is a good thing, because compared to life insurance, you will never have combined ratio that low. And even for GNW, Genworth Financial, this is only for for the PMI business. And if you look at they also have life insurance, so their combined ratio is higher. And they are trying to have a spin-off for their PMI business because they think it's going to be better for them. So for me, it's not really a problem if they're focused on this because it's more profitable compared to life insurance. And there are also many tailwinds in this industry. About the competition, yes, it is very competitive. There are 6 companies, maybe other companies would want to enter, but and they are taking market share away from government agencies. So it's not just Essent Group, the whole industry, the private mortgage insurances, they can compete with the government agencies. But what will make Essent Group better is that they have already shown how they have been growing in recent years, and it's also about the quality of the loans. They have shown that they can be very strong even in 2020. In 2020, it was a record year for the company in terms of new insurance return, but because of all the foreclosures, everything, then the income went a little down, but still they were profitable. Then you asked about the macroeconomics. The macroeconomics, nobody knows what will happen. As a value investor, I like to focus on the business. Of course, I look at all the different scenarios of what may happen. But as long as I think we have a business which is undervalued, we take the margin of safety, we don't need to worry whether interest rate is 0% or 2%. For me, it's not really such a problem because in our margin of safety, we have taken even at 2%, 3% interest rate, it should be okay for the company. People will still buy homes, people will still need mortgages. About the GSE, here it is very difficult for me to pronounce myself on this because even as a group, you're going to read the 10K on the risk about the GSE. They say they don't know what will the government do. Right now, these companies are controlled by the government. If they are going to be privatized again, how will this affect the PMIs? I'm not going to pronounce myself. We will see, but I don't think the government is going to privatize this anytime soon.
Okay, thank you.
There's one more question in the chat, Ishfaq. I don't know if you can read the chat. You can't?
Can you hear
Okay.
me?
Yeah, Matthew, go on.
I tried to raise my hand, but I guess you can't see it. Ishfaq, I have a question. Do you know maybe the exposure to the FICO consumer for the company? What's the rating for their client, the FICO score?
Okay, I don't have the exact number, but they have the highest. This I can know for sure. No, National MI have the highest right now, but as I mentioned, they are very choosy on their loans, and they are the smallest of all the PMIs. If they want to expand, they can be that choosy. But Essent Group has the second highest, so they have the second best loan quality.
So basically, I think I asked the question because when you and I spoke before, I didn't know the answer for that. So what I can say to the people that listening is that the main problem with the COVID effect is on the really low FICO score and the non-FICO at all, the subprime lender. And this is where the problem is, and this is where the problem I think is going to be after all stimulates will fade down. And from this point, I think that the risk associated with the future, you know, as the lady before asked, if all the incentives will go down, if the default will increase, I would assume that it's not going to be that much in the high FICO score. And this also side of consumer are the one that actually moving from metropolitan, and I can see that from my investments in the real estate industry last year, that many people that lived in metropolitan moved to suburban because of the COVID, and you can see that moving even faster. So that's why you see it increasing. So I hope that's answered the question on this side.
Yes, and I want to add something. if we look at the vintage of all the loans that these companies have, Essent Group, they came into existence 2009. So they don't have those bad vintage like Genworth Financial has, for example, because it's pre-2008, before the crisis. At the time, the loans were really bad. So it was very easy to have a mortgage. So these are the, like Matti mentioned, these are the ones which are going to be the most affected.
I think there is also another point that I will consider. Maybe that's why we have some pressure on the share price. It's exactly as we just spoke about, is also we have Democrats in charge now, and any company that gives people some, what I call some access to money that they cannot get as a regular person from the bank. So I mean, it's always, being afraid from the regulator, attacking those companies, don't give 20% to a person that cannot handle that, although there is the GCs and everything. But I think this is also sort of a pressure. But this type of investment, there is, I personally always like to look at the catalyst. And I think there are two catalysts here. First is that in compared to other buy now, pay later and all those kinds of finance companies, I don't think regulators are going to go after any of those six competitors. That's the first part. And the second part is that, as the lady asked before, if the macroeconomics will fade down and we will see that it's not that affecting all the six in the same way, so that can be a really nice catalyst, because at the end of the day, this company and the whole industry as a whole got much higher price to book. And this industry for the past, I don't know, 70 years is measured by price to book. And this is pretty much at a very low rate. So unless they are really going to increase their defaults, charge-offs, I mean, it's in historical point of view, it's pretty cheap. But again, assuming it's not.
Thanks. And there's one more question, Dimitros. I don't know if you can see in the chat. Is can we now look at the quality of their book compared to their competitors just by checking the good years?
I'll have to. You mean the loans that they are giving? So as Matti mentioned, they have the lowest credit score. They have the highest credit score. But as I also mentioned, they don't have the bad loans for the pre-2008 crisis. And yes, so I cannot show the exact, I'll have to look for it for all the loans that they have. But in short, I have looked at all the PMIs and they have the best loans. National MI, they're still small, but compared to the top 5, they have the best ones, Essent Group.
I think also another important point here, and I guess for me as an investor and for everybody, they would ask how these companies survived 2008, 2009. And I think it's a very good question. And it's something if you can come back and then, bring some numbers to see how they did survive that can be interesting. But on the contrarian, and I always tell it to people, is that no previous crisis is going to be like the next crisis, and everybody taking the last crisis as the next one, and not every crisis is equal. And the 2008 crisis, it was dedicated for house booming, and we don't see it, not in the numbers of the household, not in the numbers of price in the US. So in order for 2008 to repeat himself, and for those company, all the 6, by the way, I'm not just talking about this company, we need to see some way worse market than what we see now in a bubble way. So that's how I look at it.
So what I can say on this is that before 2008, we did not really have these 6 companies. We had 8 PMIs then, and many of them went bankrupt. So there is only Genworth Financial, which was here, this Radian was here, and also this Arch was here. So these three, Essent Group, MTG, and National MI, they are pretty new. And there were also at some point, there have been some other companies, but then they closed down. But only these three actually before the crisis.
So Essent Group wasn't before the crisis?
It's after the crisis.
Okay.
So that's one of the things I like about this company. So they don't have any of these bad loans at all before the crisis. And
Okay,
the
one
whole,
last, sorry, go on.
yeah, the whole mortgage industry changed after the crisis, because now it's not only the banks giving mortgages, we have the non-bank lending institutions. So the whole industry, it's like a rebirth of the whole industry. And these 6 companies, 3 of them are pretty new.
Okay, last question. Can you say something about the reinsurance? So business ceded to reinsurers?
So they reinsure part of it, and part of it they use other companies.
Okay, but which proportion is ceded to reinsurers? Is it 1%, 10%, 20%?
I don't have the exact number right now.
Okay.
Okay, Ishfaq, thanks a lot for your presentation. So guys, if you, Ishfaq is one of the value investors on eToro, and because eToro is a social trading platform, you can follow him. So whenever he invests, you invest as well. Of course, do it only if you trust him or anyone else on the platform. Then it's obviously your choice. So, and I will share out the link to his profile in the next email to everyone. Thanks a lot, Ishwak. Really helpful. So now we,
Thank you.
Now we go to Manuel. Over to you. I will have to stop sharing my Netflix password. Yes. Sorry, are you trying to share your screen? We can't hear you, Manuel. You're on mute. Or
sorry, can you hear me?
yes, yes. Yes. Can you share your screen? Yeah, we can hear you.
Can you hear me by any chance? Oh, yeah. Okay. Sorry for that. Yeah, I'm sharing my screen now. Let me know when you can see it.
Yes, yes, we can see it. Go on.
Yeah. Okay. Perfect. So as you were saying, Rubis, thanks for that. I'm gonna be talking in the next maybe 10-15 minutes on a company that you probably very familiar with, but sometimes perhaps overlooked from a value investing perspective. It's seen as a potentially overpriced or no much growth potential remaining, really. I just assume that everyone has heard of Netflix within everyone, but I would probably just take this opportunity to do maybe a quick poll, if I may, just to say across the audience, how many people are probably subscribed with the Netflix services in any kind of basis, really. Not interesting to know what kind of program or package you're using, but I don't know if you mind saying, maybe raising your hand if you are subscribed to Netflix or you're using it on a monthly basis.
I think we might have a technical challenge with that, Manuel. Okay, we've got a few people.
Yeah.
Yeah, but I think most people, I would say, Manuel, have it.
So I think it's very good. So I just when I talk to people, really, most people say, well, Netflix is currently extremely overpriced. It's trading at all-time highs. It's about 560. This is currently no current market close, so it was about, I think, on the 5th of March, but you get an idea. I think potentially the argument probably a bit flawed, because you cannot really get a sense of what a company value just looking at the price, and definitely know in the future growth potential. So you could say, for example, in 2011 was it was trading all-time highs. Same in 2014 was trading all-time highs. Same in 2017 and obviously now in 2020. So no quite an argument. The other thing I hear sometimes is, well, the company has returned about 42,000% over the last, I don't know, 20 years so. And I think why this is true, and potentially if you buy now Netflix, you are not going to get another 42,000% in the next 10 years. That will be a company of the size of, I don't know, 80 trillion. I think the case I wanted to make today is that you can have at least a good potential growth and return over the next 10 years of the size of the range of 10 to 15% going forward. Another thing that people say, well, the PE is about 87, is crazily overpriced, and I do agree with that statement. But also gonna defend that that price to earnings is potentially a bit misleading, and you probably see in the next quarter where that PE is gonna drop to a more sensible range of 40-ish number, and probably stay within that range going forward and decreasing. Therefore, decreasing on that sense. And also it's facing a huge competition, so we think we'll talk about going forward, but things like Disney, Amazon, Apple, and so on, which is kind of saturating a bit the market. Just before going any further, I just probably a small disclaimer. The analysis is going to present, I think Ruben was mentioning at the beginning of the presentation as well, is my opinions only, so I'm not encouraging anyone to do anything, just presenting my analysis based on industry data though, but just my opinions only. Yes, I do hold shares of Netflix as the previous presenter on the company that was referring to, and it's actually a quite significant amount of my portfolio. I think similar to the previous presenter, I only invest on the long term, so I don't expect any kind of quick returns or 100% on the next, I don't know, 4 weeks or so. I'm not in that game. Just when investing, just gonna cover quickly what I call the 4 key pillars for myself. So looking at the meaning of a company, do we understand how the business makes money and what it's about, the fundamentals. So looking at the financial statements of the company and how it's been growing for the last 10 years, as well as the potential growth going forward. But also the pricing, so comparing the current price to the intrinsic value, and as well as just kind of what would be the potential growth if buying today, really, as opposed to the price in 10 years. And then finally, just a closer look at the management style, really, the exec team, how they get paid, what are the incentives, and so on. So just quickly looking at the meaning, just outlining one of the best, the key criteria for what I believe Netflix is a good investment. First of all, it's really, really simple to understand. It's a very simple business. I think we all understand how they make money based on subscribers and the amount of money that they get from those subscriptions, really. And also how they spend money and what's the main cost of revenue, which is producing content. I believe Netflix has also a competitive mode. So I think the demand is probably inelastic to price increases. So Netflix has been consistently increasing the base price without significantly dropping customer base, really. And that's probably something I wanted to mention, and a quick note to competitors. Yes, we are seeing companies like Disney and Hulu, Apple, and others increasing huge amount of subscriptions over the last few months. But I think we need to also bear in mind that the ARPU of those companies is significantly lower. So we need to understand what is the pricing power going forward. I also think they have a first mover advantage, and obviously the largest subscription base, which means that it's cheaper for them to produce content on a per user basis, and obviously also get access to better cast, better kind of studios, production companies, and so forth. And you can see that coming now in the latest series and movies that they are producing, where they're increasing demand. Is, I would say, broadly unaffected to economic downturns, to the macroeconomic picture. I think having on-demand TV is becoming almost a basic need. And if I venture to say, I think on deteriorating economic conditions like crisis and so on, and not only particular crises like COVID-19, but also any kind of crisis, I think There's a studio that says that most of the people accessing this kind of services will be likely to mean, if they could only choose to maintain one subscription or one provider, that would be Netflix. So will they kind of deprioritize others on detriment of Netflix? One particular bad thing for Netflix is if the cost to debt increases. Netflix has a significant amount of debt that will be covering later on their financial statements, but we'll see that this is becoming less of an issue as we move forward. And just finally, it's not a cyclical company. I believe it's not like you buy Boeing or you go into aviation where you have ups and downs. I think it's a potential growth company where they have a significant addressable market of about 850 million households, which, assuming a 60%, 65% penetration rate, that would be about 550, which is almost 3 times the current 200 million subscribers that they have. So they have a potential of 3x times increase in subscription, and obviously the total addressable market is only going to grow as more households become get access to internet. Final point that they're going to increase. They are the largest content expanding in the market, and that's due because of the largest, obviously the largest subscription base that they have. Quickly, just going through starting from the fundamentals and really the number of subscriptions and how they are growing. I nicked this chart from the Q4 earnings report, which if you haven't seen it and you are interested in Netflix, I definitely recommend you to get access to. And you can see that Netflix has been growing subscription base consistently almost over the last 4 years and previously. Obviously, you have the blue line here where you can see a massive jump just because of COVID in 2020, and that kind of distorting the final growth of the company for 2020 by to 35 million or so. But you can see that at least they have been growing by at least 20 million over the last 4 years, and this is expected to continue, as you can see, coming forward in the next years. One thing I will caution here is that probably the new growth is probably going to drive a lower ARPU as it kind of get and expand over areas where they have a lower subscription price, like LATAM, India, and other countries where they are targeting it very heavily now, but probably yielding a bit less revenue per user. Just a quick chart developed by myself on the revenue, income, and free cash flow put together. You can see that the revenue has been growing in the last few years, more than doubling in the last 5 years. And it's just really what I like of this company, it's really easy and very predictable and really easy to understand how it's going to continue growing. As I say, 2 main factors of how revenue is being driven is the number of subscriptions that keep increasing, and the revenue per user, which also keep increasing as Netflix is able to put the price up consistently without losing customer base. You see the other 2 lines, the green line and the red line, representing net income and free cash flow. A slight misaligning there. I normally like to have those 2 figures very close together. And I think the main reason for that misalignment really is the way they depreciate their content in the balance sheet. So Netflix depreciate content over a 4-year span. So mainly meaning that all the kind of heavy cash flow that they're investing now, it doesn't really get reflected on the income statement straight away. However, what is important here is in the long term, those 2 numbers align. And you can even see in 2020, where because of the pandemic, they haven't been able to spend as much cash as they wanted. Those 2 numbers have aligned a little bit, but I guess free cash flow is expected to come down a little bit in 2021, just breaking even from a historic negative position, and then just going up as revenue is able to accommodate and fully offset the content expenditure. And this is really key for Netflix because until now, until 2020, 2021, they have been paying for the content expenditure based on debt and issuing shares. And this is something, a kind of a critical point for myself. when I'm analyzing Netflix, this is going to change now. And now that they kind of managed to grow and accumulate a significant amount of revenue and user base to pay for content going forward. Just very quickly touching on profit margin. Profit margin, which is a metric I look very closely, has been increasing over time as net income has been increasing. It has gone from 2% in 2016 up to 11%, which is a respectable number in 2020, but got forecast to continue increasing really and reaching a 20% level, which is what I like to see by 2023. Not going to expand much on this. The other one is about debt levels, and that's one of them kind of the key things that I was a bit more worried about back then when I bought Netflix long time ago, and the numbers look a bit less rosy, and it's how they were financing the content, as I was saying. So you can see the debt was going up every single year on year, whereas net income, yes, was increasing as well, but the debt to net income ratio was in my opinion quite high. So it was from 15 coming down to 9, and nowadays, which is about 5 point something, which is still above the 3-point level I would like to see on companies, but it's really definitely approaching that kind of 3 mark, as you can see in 2021, and forecast to be above just below 1 or above 1 in the next few years. And the key for that is just a statement from the executive team and the leadership on trying to maintain debt levels on a range between 10 to 15 billion, currently on 15 billion now. And that's just because they now manage to pay for content based on full revenue without having to issue much more debt. Just this is a quick summary. I'm not going to go into huge detail, but this is kind of the key metrics I look for. It's just a summary of the last 10 years. I think we covered most of them, but sales, which is revenue, increasing consistently year on year. The other one is the operating cash flow. You can see a massive increase last year, but this is mainly driven, as I said, because they couldn't spend as much as they wanted on content. So it's kind of a fake huge increase. But however, earnings per share, which is a key metric, is again consistently increasing. Book value per share also increasing over years. And perhaps for me, actually the most critical metric, which is the return on investment capital. Not quite there on the 10% levels that I wanted to see, but I think it's becoming much better over the next years as they kind of grow their customer base and are able to produce revenue and income with the existing capital expenditure. The other thing that worries me a little bit, as I was saying, debt about 5.73 of net income, but as I was referring back in the previous slide, just forecast to decrease. The other thing is about shares outstanding. You can see a chart I nicked from Macro Trends, where you see that Netflix has been issuing shares over the last 8 years. So since 2012 has increased. So they have increased the outstanding number of shares by 18%, which is a bad news for investors like us. So we've been diluted effectively. But I think the good news on this is twofold. One is that that increase on number of shares outstanding is been decreasing over the last few years by less than 1% per annum now. And also they said the executive team and the leadership team said in the latest Q4 2020 earnings call that they are expecting now that they reach break-even position with free cash flow, they're expecting now to buy back shares. And I do believe them because they have done in the past. You can see here where before 2012 they were aggressively buying back shares. So I think I believe when they say that. I think just quickly before moving on to pricing, which is kind of the final point of my presentation. I guess there will be some questions coming on the chat, but I don't know if you can hear me well. Everything okay? Yeah. Okay. Just finally on pricing, something actually similar techniques really that what I see in the previous presentation. I normally do 3 methods, but I'm conscious of time. I'm not going to be able to kind of go through all of them. I'm definitely not going to go through the third method, which is the most similar to the previous presentation, which is more based on discounted cash flow and terminal value, and pricing back to today's value. I'm going to focus on the first one, which is a bit more simple one you can develop on the back of a napkin, really, and it's based on earnings per share growth. So very quickly, just looking at just my estimate, and also the process I normally follow when I do this, and also more importantly, just you are able to build marginal safety as you do that. But just starting from the simple equation of earnings per share multiplied by PE, and obviously, as you all know, PE just been a multiple that is mostly driven based on the growth potential of the company. So the higher, the most growth potential the market is willing to pay, and therefore the premium. So just estimating the EPS in the next 5 years. So just taking a bunch of estimates from analysts, from Yahoo Finance, or public sources like Sachs, Simply Wall Street, etc. Collection of those EPS growth potential for the next 5 years. Doing a quick average, which is about 32% the next 5 years, which I think is quite conservative, because just next quarter growth is gonna skyrocket. You can see now coming from the analyst expectation, but just keep it conservative for now, assuming a 32% increase, and even building again more margin of safety. So lowering that for that growth potential by 80% for the next 5 years, which reached to a 26%. Applying that compound growth over the current EPS, which is about 6.08, you get about an EPS of 1958 in the next 5 years, and doing similarly for the next for the 5 years after those, and applying even a more conservative growth rate, which is about 60% of the average before, you get an EPS of 48.25. Now the tricky question is now which PE you use to multiply that. So what I do normally is just take the EPS, the forecast EPS, which is the kind of conservative one, and assume a 1.5% price to earnings growth and 1.25 price to earnings growth in the next 10 years. Just perhaps a bit generous in this case, right? I'm doing 1.5 and 1.25 rather than 1, but I believe Netflix has a bit more growth potential, therefore putting a bit of premium there. Doing that, you get to the kind of target price in the next 5 years and 10 years, which is about 774 and 1,000 over the next 10 years, which give you a compound annual rate of return of about 8.4% based on current price, which, by the way, sorry, it's not current price, it's just the market close on the 5th of March. But more interesting to see what's the range and what is the current target price based on the kind of return that you want to expect. So buying at today's price might give you 8%, but just you're expecting a 10% target for that would be around 480 based on this simple calculation. You are a bit more aggressive and expect a better return, which is about 15%, which is kind of my mark. Normally, when I invest, that would be about 384. You can clearly see there's a bit more in a graphic manner, really, and you can see kind of the price to get a 15% return over the next 5 years, about 385, and the price to get a 10%, which is a bit lower, and where we currently, which is a bit lower than 10%, about 8.4, which is one of the personal criteria on a whole basis. So not the time to invest now and to jump in, but definitely to watch in as per the expectation in the future. I'm not gonna go to the other methods, but just they kind of yield very similar results, which mean they're more or less in the same kind of range, really. Both the future cash, the free cash flow analysis, which is similar to the earnings per share, and obviously the discounted cash flow as well. And just very quickly, just before finalizing management, a quick close to the management style. This is something I normally like to do, just looking at a bit more at the CEO and so on. CEO, as you all probably know, Reed Hastings, an entrepreneur by definition, was the founder of Pure Software before Netflix, a company that wasn't very successful at some point, but was later acquired, and then he kind of applied all that learning on his next company, which was Netflix. I believe I really like the leadership team. I think they are very conservative. They provide good guidance in the quarterly reports, and they normally deliver on what they say, and they never overshoot themselves, really. They have also a very clear company culture. I don't know if you managed to you have seen the book that they have recently published, but they really lay out really what is the company culture and what they do, which is just really in a nutshell, keeping the best talent and obviously paying the top of the market to keep that best talent within the company. I really like that the CEO is the founder of the company and has kind of the long-term alignment of the future of the company. So it's not kind of a new executive team on a really big wage, looking only for short-term results. And then touching finally on the wage, I really like Reed Hastings' compensation. As you can see, base pay about 700K and no bonus. So most of his compensation is just based on options and stock-based compensation, which is something I like. Not so much the same case can be said by Ted Sarandos, which you probably know is the chief content officer, so production officer, but is now being promoted recently to co-CEO and has a significantly different compensation package, still significantly driven by stock options, but way more heavily based on a fat base pay, which I don't know if anyone in the call knows a bit more why that's the case. I really don't know, but don't see is the same incentive there. And then just finally, the ownership of the company, about 1.55% of shares being held by insiders, which is I would like to see companies will have more percentage held by insiders, but I think due to the size of Netflix, I think it's a considerable percentage still. Yeah, so I think that was me in a nutshell. I think I've been rushing a bit just to keep it within the 15 minutes. Apologies if I've gone over, Robert, but I would really like to get any question and more importantly, any challenges from anyone if you see that I'm missing something glaringly obvious or something I'm not considering properly.
So before anyone gets it, okay, let me start with a question. What for net? I mean, a lot of companies kind of once they perfect one thing, they move into other things and do it better. So like Apple does a lot of things, Amazon does other things, but Netflix, like, do you know what is the next big thing once they have massive penetration of households globally? What next for them?
To be fair, I don't know what's next for them. I think that would be almost impossible to say for me. But also, I would say that they have gone through a journey. So you probably remember that Netflix started being a DVD buy mail company. So back
I used it. Yes, I used it 80s. Yes, I mean CDs actually, not even DVDs. I think. Yeah.
But back in the day, so I think it has gone through a journey. Then moving on to licensing content, probably the first company offering that offering. And then even moving on to producing their own content, which is the next stage. And now they call the fourth stage, which is international penetration, really, and tailoring the content to different audiences. I just saw the other day that they released a good Indian movie, just trying to reach and penetrate heavily, betting heavily on that market as a net growth potential. So I don't know what's the next thing, just to answer your question, Ruben, but what I would say, if there is a next thing, they are prepared to do so. And why I say that is because of the company culture and how they work with that. And if you read the book that I said, Netflix No Rules, you understand because how they do it. They are really they're always looking for top performance and people not get settled within the job and really looking for kind of the best talent to drive innovation. They don't have a kind of pyramid decision making. So it's not the CEO making the decisions most of the time. It's the people that are actually doing the work that are the most informed, and they let those people making the decisions really. So I think how the company is being set up, I have full confidence that when the next thing comes in, they will be the first one to be able to adapt.
Sounds good. Thank you. So we have a question from George. Can you go back to slide 14th? So it's a start of a question.
Yeah.
George, do you want to ask your question, please?
Hi, Manuel.
George,
can you hear me?
Yep.
Yes, you go on.
I kind of have the same question because I was valuing actually the company back in December, and after the 5-year period, I can't find a way that the company will keep growing double-digit growth on the top line. And the only way I found that the company can do that is by raising the subscription fees, which I believe is going to be very competitive if they do that. So Khan is the same question, but after the 5-year period, I'm having trouble seeing the company keeping growing top line double digits. And I wanted your thoughts around that.
I think growth is probably going to slow, as you know, has reached probably saturation now in the US. I think that's something that even they acknowledge, and Canada probably reaching that point, or at some point will reach that in Europe. I think the next growth markets for them are LATAM and Asia. But as I said, the ARPU of those areas is slightly slower. So I think they're gonna struggle a little bit maintaining that revenue growth going like double digits, as you say, or especially high double digits. So at some point they will need to kind of do something else. I understand, but I think for the next at least 5 years, I think they'll have a good future. Next 10 years, even though that kind of revenue can slow down, I think potentially still good price. But yeah, I think they will struggle at some point when they get that saturation across most markets. And the other point about increasing the revenue per user, I think there is a limit to that. I understand, but I think the kind of the main aim is really to produce the best content out there. So they are expending this year about 16 billion, which is no other company, Disney, others are spending that amount of content. And to be fair, once we are back from lockdown, where we are going to start prioritizing our time, we won't be able to kind of subscribe to every single provider like Disney, Hulu, Apple, and everything, just because we have lots of disposable time. Once we kind of come from that, I think we are all going to choose just one or two, really. And we are going to choose the one that give us the best value, in my opinion. And I think that's going to be Netflix.
So now
if I may,
sorry, Matthew,
if I may
two more
ask,
questions. There are two more questions, Matthew. Let me just go through them.
Go ahead.
Okay, yeah. So there are two. One is interesting question. What will happen to the share price when cinemas and stuff reopen across the world? And if I may expand, people might want to go out at least in the short term. So do you think this spike you saw in Netflix subscription might result in churn?
I think I was saying that the subscription growth is probably going to slow down a little bit, although I believe they still go up because they have more addressable market. What I still believe, and people in this call tell me, once we are out of lockdown and we can go to cinemas, restaurants, and so on, are you really going to cancel your subscription in Netflix? Me personally, I won't. I mean, £6 is not the end of the world. You can spend that in a beer one night in a month. So I personally not gonna cancel my subscription. I believe many people won't be doing that either. So I believe they are not gonna lose many users even after lockdown, and they have potential to keep growing. So I think it's not a secure revenue flow, but I think has a very predictable revenue flow in that sense. Unless just people in the call just tell me what are your views on that.
No, I think it's everyone's opinion. Thanks. And one more question is, how is Netflix PEG stand versus Amazon? And then I think it's better to look for you in the chat. I think it's in the chat. So the point is, it's less diversified, less sheer size effect. So how do you compare Amazon versus Netflix and others?
Sorry, I'm not sure if I understood the question. Sorry.
Okay, let me read it out as it is.
Yeah,
how does Netflix PEG stand versus competitors? Amazon market cap 1.5 trillion, PEG 2.69, Netflix 220 billion, 2.5 PEG, which is less diversified and less sheer size effect.
Don't know. first of all, I'm not sure you can directly compare Amazon to Netflix in valuation purposes and on company size, on anything really. Yes, Amazon is operating on, a small amount of Amazon is operating on Amazon Prime, which is the video stuff. But Amazon is way bigger than that. It has, e-commerce, Amazon Web Services, more importantly, which is how they actually get income. So I think it's just not comparable really. What I would say of the PEG, the price earnings growth, if that's what you mean, Robert, is slightly high, in my opinion, and that's why in my forecast and calculation, I trimmed that down considerably and being way more conservative. And if you've been more conservative, you still get value of buying the share. I think you have a case there.
Thank you. Matty, your question?
Yeah, I just wanted to ask, do you have the numbers for how much they spent on content in 2020 versus 2019?
Yeah, so from memory, I think 2020 was about 12 billion. And that's not because they wanted to spend 12 billion. That's where because they could only spend 12 billion, if that makes sense.
Yeah, but how much in 2019?
I can't go back to you, but it was I say it's here. No, I don't know. It was just less than that, or at least similar. Probably was actually similar. I can come back to you. But
I'll tell you why I'm asking the question. If I remember right, it was much more than that, and the reason is because you could not do production in 2020 due to COVID. Closed studios and everything together. And my question is, why I'm asking these numbers is maybe this is why you get the higher return on invested capital in the past year. I mean, it's inflating the return because you spend less. So I'll be happy if you can get back to us on this point, because COVID was something really unique on this side of spending, and you can see it in all competitors, not just in Netflix. So that's on the first point. On the second point is that you're talking about no one living them because they're going to go out of the house and everything, and I agree with you, but the question is whether the growth is really going to go back to 2017, or it's going to be zero growth, or maybe way lower than what everybody expecting, because it's like in 2020 they got forward 5 years increase in subscription just because the COVID. So how you implement that in margin of safety? I mean, what's the margin you take in here from perspective of, to be on the safe side, just assuming the growth is not going to be the way you'd like it?
Yeah, so on the first point on free cash flow and the money that they spend really on content, I think it's probably slightly higher than you might think, actually. I mean, they struggled to spend as much as they thought, but they didn't end up spending about 12 billion at least, or on a daily basis, and that's because they could actually film quite a lot of stuff just by doing COVID testing and all that, and probably the cost went up as a result, but they were able to kind of produce quite a lot of content, not as much as they wanted again, but yes, that's the point. But you can see that the spending in content is so this year is about 16 billion. And still with that 16 billion, they're forecasting to kind of break even in terms of free cash flow here, and probably continuing the same level of expenditure, kind of increase become positive free cash flow basis. On the subscription, yes, 100% agree with your comment. 2020 was an exceptional rare year, as you can see. In probably in 1 quarter or 2 quarters, they got about 25 million subscription, which is probably what they get in a normal year. But I think you can also see that the remainder of the year was quite slow, and they only ended up in 2020 with about just over 35 million. And they are very conservative on that. They are forecasting for the next first quarter as low as the worst year, which is 2017. And even if they only are able to kind of increase customer base by 10, 15 million going forward, I think it's still are very reliable source of revenue just by maintaining the current subscription base, adding a bit more on top and increasing the ARPU. So that's why I've been trying to kind of, when pricing it, try to be conservative. Most of the analysts, as you probably are expecting the EPS between 23 to 29 in 5 years. I'm being way more conservative and say, well, that's probably just do it by 80% of a simplistic average growth. And talking about 19, and probably you might argue that my PE is a bit higher, which is almost 39 and so on, but you can play with that. I'm not saying that it's a good time to buy now. What I'm saying is sometimes a company that gets seen as a very overpriced, the growth potential already passed. And I think I agree with those comments. I just think that there might be some more returns to be yielded from this company if we continue to hold, and if drops a little bit, maybe just buy a bit more. But yeah, I 100% agree that it's reaching saturation in many markets.
All right, guys. All right. So last question, Ishfaq, from you.
Yes, I have a question on 2 points that you mentioned. The first one, you say that right now people are using Disney Plus, Amazon Prime, and Netflix, but afterwards they're going to go only to Netflix. So why do you think so? Because if I had to choose one, I would think that many people would choose Disney Plus because of the content that they have. So, and it's not just, and you also, second point that you mentioned, you cannot compare Amazon with Netflix, but you can compare Disney with Netflix. And as I'm saying, Disney, they have all this content and they have the parks, everything is linked, they have ESPN, sports. So how can Netflix compete with that? Because we know content is king and Disney had the content.
Yeah, and I think I'm not gonna argue against that. You are a Disney user and you feel that you get more value from Disney, and that's if that's the sentiment across the piece, it might be the case. But the only thing I would say is that Disney has a significantly lower ARPU. So I would like to see when Disney tries to actually get money from their users, how many they remain. And if they see that, as you say, if they are adding as much value as Netflix and they are willing to pay double, that's what they pay now. Because at some point, Disney, I believe, will need to start ramping up and collect more revenue. But as I said, I know if you really, I mean, it's a good point that you're making. If you believe that Disney offer more for less, it's something to consider. Yeah.
So thanks, guys. I think we've run out of time now. Thank you very much, Manuel. Guys, as I said, so we will share this out, the screen share, so you can look at the numbers, the slides in detail. And yeah, if anyone wants to present, please let me know by email and we'll do another session next month. Thanks a lot, guys. Happy investing. Have a nice evening. Bye.
Thank you.
Bye.